Okay, before we head into the weekly outlook, let me just, for those who have the applied series, let me just update you on where we are or what I'm working on. I'm in sector studies. The next one going up is the healthcare sector, and then there'll be a longer video on understanding pharmaceuticals and biopharmaceuticals. And just to give you a high level view of what it looks like, we'll be covering off manufacturers, distributors, and PBMs. These are pharmacy benefit managers. Many of these have mail order pharmacies. So it's important to know these. Manufacturers can fall into the branded and biologics category, the generic and biosimilars category, and the specialty category. For the branded and biologics, I'll use excerpts from Pfizer. From generics and biosimilars, I'll use excerpts from Teva. For the distributors, I'll be using excerpts from McKesson, from Cardinal, and from Cencora. If you find this to be a new name, that was as of August 30th. Previous to that, they were AmerisourceBergen, but they changed their name to Cencora. So I'll be using excerpts from these three. PBMs, it'll be a mix of a few that I'll be using. But this is the high-level view that we'll hope to understand is how the drug travels from the manufacturer to the patient, and who are the players at the level of the manufacturer, at the level of the distributor, and the pharmacy benefit manager, and the economics of them. And when we get to generics, there's a very curious economic relationship that occurs in generics that is causing some issues today. So we'll discuss that a little bit. So the healthcare sector, and then the longer understanding pharma and biopharma. Whenever I do one of these things, it's about 2 to 3 weeks of research, a lot of research. How it works is you start making notes, and you'll end up with 40 to 50 pages worth of notes, and then you have to shrink that down to about 15 pages. So you'll over-research, and then you have to shrink it down. And once you shrink it down, now you're ready to do your screens. I'm in this phase right here. Each one of these take anywhere from 2 to 3 weeks to do if you're going to do it well, and I think you want it done well. Ones I've already done, for those of you who are not aware of what the sector studies is all about, it's an overview of the sector along with a deep dive into some aspect of that particular sector. So for materials, I did an extended video for understanding mining, and then I used Freeport. There's another 4 hours and 43 minutes just on Freeport. This one here is less than an hour. In the utilities sector, I chose electric utilities to go further in depth on. That's an hour and 28 minutes, and I use NextEra as the case study there. Real estate, there's understanding timber REITs. It's an hour long. I use a couple of timber REITs in there. And then another video for understanding retail, office, and industrial REITs. That's another hour and 25 minutes. And the real estate sector video is about 3 hours. And in there, I go into apartment REITs and apartment REITs and something else. I think most of it is apartment REITs. I really dive into that one. The financial sector, you'll find understanding banking. It's a 5-part series because there's just a lot to know. Almost 5 hours, a little over 4 hours long, 4 hours, 5 minutes. I use Huntington Bank as the case study there. In the energy sector, there's a longer one, understanding oil and gas exploration and production. That's almost 2 hours long. I use Oxy as the case study there. Information technology, understanding semiconductors, 1 hour, 11 minutes. And it's really what I show you up here, this whole chain, manufacturer, distributor, pharmacy, patient, all of this that I've just circled. I do the same for semiconductors, except you have design, you have manufacturing, and then you have assembly, testing, and packaging. Design has suppliers, manufacturing has suppliers, and they're the same suppliers for ATP, and we go through each of the seven sort of sub specialties in the semiconductor industry. So for those of you who have the applied series, this is the next one. You'll see the healthcare sector and a longer video on understanding pharma and biopharma. Just to give everybody a heads up, right now the applied series is 320 US. As of December 1st, November 30th will be the last day of this price. As of December 1st, that goes to 440. Just because the content, the price was going to increase over time as the content increased, because I'm still building it out, and I will be building it out for years to come, but there's enough in there to justify a price increase. So this is the last month for 320. Starting December 1st, it will go to 440 US. All right, let's look at the week we had. Well, almost everything went right for yields last week. Look at this from the 3-year all the way out to the 30-year, basically a 25 basis point cut in yields. And on Friday, there seemed to be a desire to take yields even lower, but it gave back during the day. If we look at the price of TLT Friday morning, it went up, and then it just sort of gave back during the day and went sideways. I think there was a lot of short covering going on after the jobs report, because treasuries just kept going up every day. The data seemed to come out just in the right spot to support an increase in price in treasuries. So I think that you had that peak short covering early Friday morning. Rates down across the board. Money market rates are down in anticipation that we have now moved to phase 2 of monetary policy, which is the longer part. High for longer, not higher, high for longer. The higher is done. We are where we are. At least the belief is that, based on how Powell handled the press conference, that pretty much this is it. In fact, if you look at other central banks that ECB, Bank of Canada, Norway, Bank of Japan, Bank of England, Fed, all did nothing. Bank of Japan moved their 1% on the 10-year from a firm 1% to a, you know what, we'll keep it around 1%. They just sort of changed the language to make it not as firm as it used to be. Bank of Canada, in their statement, last paragraph, they do say they reserve the right to raise rates in the future if inflation or if the data suggests that that's what they should do. And I think all central banks would probably say that. But I think we're at peak rates. I don't know if we're at peak yields, but based on where the central banks around the world have set their rates, I think we're pretty much there. The central bank, they work at the short end of the curve, so money market rates will reflect central bank policy. But the long end of the curve, that's the market, and that will reflect what the market believes. And it does have to do with growth, obviously. It has to do with inflation, and on more technical sides, it has to do with the level of supply and how the market feels about that. So we have that. The Treasury refunding statement earlier in the week worked on supply quite a bit by reducing what the market believed the level of supply would be. The curve inversions were a little bit more inverted. On the 2 to the 10, 26 basis points instead of 15, an increase of 11. And on the 3-month to 10-year, negative 96 from negative 75. The SOMA balance sheet, for the Fed, the treasuries had bought during quantitative easing, down 40 billion. So at 7.225 trillion versus 7.265 trillion. I wonder if we'll see a 6 handle on this by the end of the year. The Fed balance sheet is now down to 7.86 trillion from 7.9, a drop of 40.716. So there was some less than $1 billion of extra runoff as well. Money markets, this surprised me. I expected to see a decrease in money market funds, but being that all these prices have gone up, yields have gone down, there must have been money going in $63 billion in. Retail added $24.5 billion. Both the government and prime and institutions added $38 billion to government, and a reduction in prime here. Now this is only to Thursday. We don't have the benefit of seeing Friday here. This is only to Thursday, but still Thursday had nice rallies in the long end of the curve that I would have thought that money would have left the cash market and had gone into duration or had gone into equities, because equities really rallied. S&P is up 5%, a little over 5% week over week. That this much flowing into money market funds, especially government funds, when you have these sort of big rallies going on, is a question mark. We only have 38 days until the next FOMC meeting. Only 38 days. 17 days to get the minutes from this meeting. I don't know that there'll be a lot of surprises in that, because look what's going on. Everyone with a mouth can speak. Monday, Cook. Tuesday, Barr, Jeffrey, Waller, Williams, Logan. Wednesday, Cook, Williams, Barr, Jefferson, Powell at 10:15 a.m. Thursday, Bostic, Barkin, and Powell again at 3. Friday, Bostic, Saturday, Bostic. I think that by the time we get the minutes, we will have heard again and again and again everything that was probably discussed in everybody's opinion. So I don't know that there'll be many surprises in the minutes. These will be events. These will be important to listen to. I think probably the first one, you get repeats on the second. If you're doing anything with the grains, WASD on Thursday is at 1 p.m. What are the odds? 25 basis point increase for December, sitting at less than 5%. I think that'll fade away over time. 95% on 0 basis points. This is December 13th. So what we're going to do now is we'll jump all the way to mid-year, June. And this is where we are right now at the 5.5. 1% by June 12th, by mid-year. Only 1% on actually being higher. 13% on being the same. All the weight is on us being lower than there. 38.8 for 5.25, 37.4 for 5, 1 to 2 cuts. The Fed funds futures and SOFR futures both are sort of in agreement with this, that the market is sort of pricing in 1 cut in Q2, 1 in Q3, and 1 in Q4. Unchanged on the effective federal funds rate. Reverse repo continues to decline because you do have T-bills, lots of T-bill supply. And in the refunding, there was a belief that coupon issuance would increase for Q4, Q1 of 24, and Q2 of 24. And that T-bill issuance would not. And when we've got the report out, T-bill issuance will increase over, they have a rough threshold, I think it's like 15-20% of their funding on T-bills. They're willing to go over that number. And not so much on the coupons, and not all the way out to there, but ending somewhere in Q1, necessary to go into Q1, only because you have a lot to absorb T-bills with, so why not use that? Let's see, the effective federal funds rate with a 12-month lag was 3.83, 5.33 today. If we, want to accept the 12-month lag on average, 150 basis points of rate hikes still left to be felt in the system. All those capital market cuts from the first page translate right into real rates, all down by basically 25 basis points. Well, the equivalent of a Fed rate cut, 25 basis points, and small changes in break-even rates. Fed funds futures opening up a bit more cutting for next year. The bottoming out in February still at 5.355, suggesting there'll be no cuts up to that point. When we get out to June, 5.04, down 31.5 basis points. And then if you go out to September, the end of Q3, the implied rate here, 4.735, implying another 30 basis points. And then if we look at December 24 over this December 23 over all of next year, 96 basis points. So it breaks down 31.5 Q1, 30.5 Q2, which would leave 34 in Q3. So a little more than one rate cut per quarter, with 96 basis points all the way through 2024. It sounds like 4 rate cuts, but in what quarters are they going to come? Big numbers here. Non-farm productivity, Q3 up 4.7%. That's huge. Unit labor costs down 0.8%. That is deflationary. I'll talk a little more about that in a second. Good performance. TLT 3.86%. Look at SPY up 5.85%. And volatility really disappeared here. And you can see how perfect the week was. You had the refunding announcement over here, and you had an immediate response in TLT, because it's, of course, the long coupon bond. We were expecting extra issuance of coupon bonds all the way into Q2 of 2024, and the statement believes that it can be done by Q1, and more reliance on bills as opposed to long bonds. Now this week there is a 30-year auction, so I think it's going to be important to watch that 30-year auction to see what yield it goes out at. There's your Fed over here, which continued it on. Unit labor costs, when they came out, and this number was negative 0.8. Look at the result on this one here. Wasn't that beautiful? And then the jobs report came out, and I think this is where you had the short covering. TLT got as high as 89.05, finished at 87.75, so it gave back $1.34 throughout the day. But it didn't give back gains for the day. It still finished with a gain on the day, but it gave back a lot of that excitement early in the morning, and I think that was short covering. I don't know if the short covering is done. I don't think so. So I think going into next week, you probably have a little bit more short covering. I can't see why Treasuries would retreat again and print new high yields. The refunding was the big deal, and we're seeing that there's going to be less supply of coupon bonds than originally thought. The Fed was another one. Are they done, or are they going to continue raising? And it appears that we're at peak rates and they're done. The concern was always about labor and the cost of labor. And if you're paying your staff 6% more each year, but they're producing 8% more product, that's deflationary, because your unit costs are actually decreasing. And that's why this number is so important. Non-farm productivity for Q3 up 4.7%. Earlier in the week, we got the employment cost index, which came in, I think, at a terrible color on black, right? 1.2%, or 4.8% annualized. So if unit labor costs if employment costs are going up 4.8% per year, but productivity is going up 4.7% per year, that's a wash. That's a wash. That's not inflationary or deflationary. That just cancels each other out, right? Well, unit labor costs negative 0.8, but then again, this is Q3. Q3 had huge GDP print, real GDP 4.9%. So some of this may be the outsized GDP. Whether it continues on, I don't know. What I am seeing more now in the earnings reports that are coming out is more announcements of efficiency gains to be planned over the next year by headcount reductions. Almost every second or third company is announcing, 3,000 gone here, 5,000 gone here, 15,000 gone here. I'm seeing more of that happening. And then the jobs report came out on Friday, and I don't know if you could have designed a more perfect jobs report to alleviate concern. Average hourly earnings sort of matching along with unit labor costs and employment cost index, that it's nothing really much to worry about. Unemployment, the highest it's been in I don't know how long now, quite some time, at 3.9, even though historically that's really low. It is the highest it's been in quite some time. So you had your refunding, yay. You had your Fed, yay. You had your unit labor costs, yay. You had your jobs report. Everything fell in line for the long bond. I don't know if there's enough unknown now to reverse what we saw this week and expect much higher yields. Look at mortgage rates here from Freddie, 7.76 on the 30-year fixed rate, down from 7.79, a drop of 3. But this is as of the close of Thursday. We don't have Friday in here. 10-year Treasury over that period of time dropped 19 basis points. 30-year fixed rate dropped 3. The spread increased by 16 to 309. The widest for this cycle has been 311. This is a screaming buy at those spreads. Just a screaming buy. Agency-backed MBS. If you look at the chart down here, I have 4 things on here: bank loans, high yield, mortgage-backed securities, and investment grade. And during the bear steepener, look what happened to investment grade and mortgage-backed securities. Just dropped straight down because of the increase in the yields. And when yields increase, spreads on these tend to widen, at least on the mortgage-backed securities. They didn't. On the investment grade, they did for a bit and have since contracted. But look what happened after. Look at that nice big rally straight up. And mortgage-backed, the mortgage REITs sort of agreed with that. Look at agency, week over week, up 20%. Annually, 16.63%. In fact, agency is now over its September 30th tangible book value per share. And you have to sort of think, well, you know, where were we September 30th on the spread? Where are we as of the close of Friday on the spread? And the market is anticipating that the tangible book value per share will be higher because we've hit peak rates and we appear to, from here on in, maybe go sideways, but this will give spreads a chance to settle down and contract. ABR is kind of curious and odd. Up 2.3. On Friday, it hit a high of 14.11. So if this is the closing price, it hit 14.11 and then it just sold off all day long and turned negative and finished under $13. I couldn't find a definitive reason why it had done that. Maybe next week we'll find out when there's a, maybe an announcement that they're going to issue more shares. And, somebody always knows something ahead of time. Somebody always knows something. So maybe the price action is in anticipation of something. Or maybe they did announce something and I just couldn't find it. Look at the home builders. All up double digits. DHI up almost 17%. Earnings this week. I think it's Tuesday. Lennar 15. Pulte almost 16, almost 19 KB Homes, 18 on Toll Brothers, 27% on Hovnanian. XHB, the home builders ETF, 11%. ITB, home construction, 13%. And the REITs, IYR up 8.71, PLD 948, DLR 865. In Canada, I have a Lira. I have an RRSP and I have a TFSA. Lira is a locked-in retirement account. You can't put money in or take money out. RSP, that's your registered retirement savings plan. You could put money in, you could take money out, but you are hit with a tax on the way out. And TFSA is a tax-free savings account. These were primarily all in Canadian REITs. And earlier in the year, I had moved out of REITs completely and moved into cash. So these were just earning cash during that period of time, except for the Lira. Only about half of it was in cash. I moved back into apartment REITs, Canadian apartment REITs, earlier in the week. I moved into InterRent. I moved into Cap REIT. You got to put the UN on the end if you're trying to find it on our exchange. And I moved into Killam. And I think I got this at 11.56. I got these at 40.80, and I got these at 15.65. I think And they all really exploded this week. The idea that we are at peak rates and from here on in rates will just go down, that's a tailwind for REIT valuation. If we think rates are going to go higher, that's a headwind because the present value of all those future cash flows will be lower. But if we think that this is the worst it's going to get, then this is the worst it will get for valuation. It can only get better from here if rates will drop over time. So they really exploded. So this was a really nice return just over the course of the week. I didn't sell. I'm still holding them. I'm going to hold them for quite some time. Look at OAS, the spreads here. All of them contracted. The one that contracted the least is Triple C. Triple C has shown itself willing to go along with the contraction in high yield spreads across the board. But if we look at where are we, high yield 7.78, the double B contract 13.07. That's the upper range of high yield. Triple C being the lower range, only 1.36. Maybe there is a growing concern that, well, you know what, we can be in high yield, but the Triple C, really? Still? Maybe not. Home pricing, look at the home price index month over month. Showed a gain. This is for August. Year over year up 5.6%. Case-Shiller month over month was 0.4. Year over year up 2.2%. Housing prices just not giving in. And again, structural shortage plus a technical shortage. The structural shortage meaning that you just don't have the houses available for the number of new household formations per year. When I say you don't have the houses available, that means available to be purchased. They may exist, but if they're not for sale, then they're not part of inventory. And the other more technical feature is with elevated mortgage rates, if you're sitting on lower rate, you're not upgrading to a bigger house and taking on a higher rate mortgage. It is keeping, on a technical basis, supply off the market as well. Mortgage apps for October 27th down 2.1%. All right, let's look at our jobs data throughout the week, because this is the thing that's causing concern, is that if there's going to be inflation, it's going to come from a tight job market, because the Fed has said that they do want to see some softening in the labor market, that they feel is necessary. We got ECI early in the week on Tuesday, employment cost up 1.1%. This is quarter over quarter, up 1.1%. The forecast was for 1%. It came in a little hotter than expected at 1.1. Jolts for the quits, we're not seeing that much extra in quits, 3.661, 3.663. But this was some concern, but the market didn't seem to be too concerned about it, but there seemed to be some people who found that concerning. The forecast was for 9.25, came in at 9.553, but this is a messy number to measure, because you may, as an employer, list a job opening in maybe 4 different ways in 12 different places, hoping to find that unicorn. So that each job opening is not just for one job. Or sorry, let me say that again. That every job that's available doesn't just have one job posting. So I don't know how much you can read into this. I think these are messy numbers. These are better numbers to use, because you can actually measure quits. Because when somebody leaves employment, you have to fill out a record of employment and file it, and on the record of employment, you have to state why that person left the employment. So you can actually measure that quite objectively. This is messy, so I think that this is the one that you pay attention to. Let's just jump all the way down here to the bottom to non-farm productivity, and this is quarter over quarter. So look at the employment cost, quarter over quarter, up 1.1%, but productivity was up 4.7%. So if you have employees and you're paying them 1.1% more for the quarter, but they're putting out an extra 4.7%, your unit costs should decrease. Look at that. The forecast was for 0.7. Look at that. That is deflationary. This was revised down because they're blue. The lower it is, the better it is, right? This was revised down to 3.2 for the previous quarter, and this was revised up to 3.6 for the previous quarter. I don't know if this is repeatable because Q3 was such a big number. Initial jobless claims, forecast for 210 came in at 217. I don't know that there's too much I would read into those small little changes week over week. It's benign, being that it's very low, in the low 200s. But this is becoming a bit of an issue, right? Is the continuing claims. 1783 forecast was for 18, came in at 1818. This has been creeping up over time. Okay, let's look at the jobs report from the establishment survey. 150,000 jobs added. From the household survey, 348,000 jobs lost. Labor force down by 201,000. So we should see participation rate down, and we do. 62.8 down to 62.7. Unemployment rate sitting at 3.9, highest in a while. I wonder if we're going to see a 4 on the November, when we get November's job report in December. Average hourly earnings came in lower than forecast, 0.2, which is 2.5% annually. If you eliminate the government payrolls, you say, well, government is not a sensitive, an economy sensitive hirer, they just hire. If you eliminate that, the private sector added 99,000 jobs, and came mostly in full-time. Full-time up 326, part-time equivalents, in other words, the equivalent of a full-time based on part-time, down 670,000. Temp workers even showed a gain, 6.6. High school, less than high school, gained work, and really educated gained work, but in the middle, no thank you. Out you go. So if you have no education or you have a lot of education, come on in. But if you're somewhat educated there, get away. We either want you knowing nothing or knowing everything. Well, there's a question whether or not these guys know everything. So let's just back that statement up a bit. Weekly average weekly hours, 34.4 down to 34.3. That speaks to aggregate demand, right? So you have incomes, and out of those incomes, there is the marginal propensity to consume, and in the U.S., it's quite high. That if you want to reduce aggregate demand, it's not enough to raise interest rates enough that somebody says, I could either spend my money or I can save my money because interest rates are high enough. Most don't do that calculation, and most only save when they say, well, I got extra money anyways. But to make the decision of saying, maybe I won't go to the mall this weekend and I'll buy a T-bill, that doesn't happen. So the only way to reduce aggregate demand is, being that the marginal propensity to consume is very high, the only way to reduce aggregate demand is to actually reduce the amount of money people go home with. You have to separate them from their income. So this is actually speaking to aggregate demand and a drop in aggregate demand at the margin, which is, certainly not inflationary. So based on the jobs report we had this week, I don't see that wages are acting in an inflationary way at this point, which speaks to another reason why the Fed is probably done. They're probably in phase 2 right now, which is rates are at 5.5. The second phase is, well, how long, right? We're done with how high. I think how high is over. It's going to be now how long, and the market thinks Q2 24 we'll see the first cut. Okay, SPY had a great week, but I don't know if the week was supported by the fundamentals of the portfolio, meaning the fundamentals of the companies, or if it was supported by the technique of valuation, which is discounted cash flow. And if you have a lower discount rate, you have a higher present value of those cash flows. If it's the latter, without it being the former, if the fundamentals aren't there, then I think there's still some risk in the market, especially when you start pushing your valuations up to 19, 20, 21. We're only at 18.46. But usually you want to see a market rising on earnings expectations that are increasing, not earnings expectations that are decreasing. So forward 4-quarter operating earnings, IBES 237.20 down from 238.46. Every week they're down. S&P Global 235 down from 236.43. And the market is up, which puts the multiple up. You want to see if these were going up each week, that is very supportive of continued rallies and multiple expansion if they're going up. But to have multiple expansion on earnings estimate contractions, that's still a little iffy. From a technical perspective, the 200-day moving average 423.78. S&P is at 435. The 50-day is 433, so it's above both the 200 and the 50, but below the downtrend, which is around 442 right now. So close above the 250, below the downtrend at about 442, which is about 67 points away, 65, 70 points away on the index. If it closes above this from a technical perspective, it can continue on. And the drop from week to week that we're seeing here, 237.20 down to 238.46, that's not precipitous. It's not where you would say, whoa, those are big drops. It's not like it's coming down $4 or $5 a week, coming down by less than $1 each week, but still coming down. You really want to see it going the other way, and it's coming down. Implied volatility really disappeared on the S&P. 13-week was at 100%, now 26. The 26-week was at 100%, now 46 and 24% on the 52. Earnings are mostly done. I think there's about 50, 55 companies that are reporting earnings this week. A lot of Fed speak this week. A lot of the interest rate risk is gone. That was last week. The Treasury refunding. Lots of central banks that now appear to be on hold. And wages. We got a lot of information on wages that, well, maybe it's not the devil we thought it was. Especially if you can get productivity gains. You can have wages going up 10% a year. If productivity is going up 15% a year, that's still a deflationary environment that you're in. Let's have a look at the earnings this week. Who's reporting? Okay, this is Monday, November the 6th. It gives you the time, only 1 in the morning, Constellation Energy. Everything else is after the close. You have a semiconductor company in here. You have a REIT, Realty Income, in there, and you have a pharma company. Tuesday, 8:30, D.R. Horton. Let's see how they do. Their expectation here, the estimate 393, a year ago 467. So they are expected to be lower than a year ago. It's all guidance. Everything is guidance. We saw a couple of companies this quarter have good earnings for the quarter, but terrible guidance, and their price got chopped like 15, 20%. On Semiconductor was a good example of one. Oxy down here. Look at this. Expecting 84 cents last year was 244. Drop of 65.5%. I got a feeling they're going to beat that 84. Walt Disney, they've been under pressure for quite some time. Let's see how they do. Let's see what their guidance looks like. Walt Disney, 4 p.m. on Wednesday, Thursday, and nothing on Friday. And this is after this week. It's just stragglers. It's pretty much it. Let's just scroll to the top here. This is how the earnings have looked coming in for the quarter. Now, this is not guidance. This is just the performance for the quarter. You can see 403 of the 500. And we have, 50 this week that are reporting? Where is it? 50 that are reporting. So there's really only stragglers that are left. The earnings are coming in 7% better than the estimate, but the guidance has been dropping. Revenue, this is problematic here, right? Revenue only 0.5% higher than expected. So finding it hard to get top line revenues, but to beat on earnings, they're getting it done. But that's a lot of accounting below the line that you can use to get that done. And that's the week.